Hi everyone, it's Professor Reiko. Today we are going to move on in our long-term liability chapter, and we're switching gears now and focusing on the effective interest method for our amortization. And this is the preferred method over straight line. So we did a video on straight line just to kind of as a baseline, but now we're going to switch gears and focus on the effective interest method, which is probably what your professor will focus on as well. All right. So the process to do this, all right? So if you think back to the straight line one that we did a couple of videos ago, remember we determined the discount or premium amortization because we were doing that on a straight line basis. And then we knew the cash payment because remember we always calculate that number first when we're dealing with that with bonds. And then we plugged in the interest expense in our journal entry, all right? Now notice up here, the first thing we're going to do is compute bond interest expense. Okay, well, I guess technically we would calculate the interest payment first because we would do that at the beginning of the problem. All right, so how do we do that? We compute bond interest expense first by multiplying the carrying value at the beginning of the period by the effective interest rate. Remember, effective rate, market yield, effective yield is all the same thing. Meaning you're going to multiply the beginning of the period carrying value times the market rate. Okay, and then this is just refreshing our memory on the carrying value definition: face value plus an unamortized premium or minus an unamortized discount. All right, so they were then going to determine the discount or premium amortization by comparing bond interest expense with the interest to be paid, which is right here. So bond interest expense, so this is interest expense, and then remember the face value times the stated rate is the interest payment. PMT. Okay. All right. So let's look at this problem here. All right. So these numbers should look familiar now. The 100,000 8% 10-year bonds that are paid semi-annually is the same numbers we were using earlier. All right. So we're going to do the market rate in this first one is 7. So the market rate is less than what we're paying. So we're actually paying more than the market, so we can offer it at a premium. All right. So if you notice here, I already have this number down in here checked in. All right, so remember that we did that already in the previous video. So if you need to go back and look at that, remember if you want to do your payment, future value, and I to get your present value. All right, the payment is a negative 100,000. Running out of room. The future value, I'm sorry, those are backwards. The payment is a negative 4,000. Future value negative 100,000. Number of periods is 20 because it's 10 years, but it's 26-month periods. The rate is 3.5 because the market rate is 7, so half of that, and this present value would give you the 107, 106. Right? So we did that in prior videos, so make sure you go back and watch those, because if you cannot calculate the issue price of the bond, you can see that's the number that's going to drive this entire table, so you will be in a bad spot. All right, also don't forget the first thing we would do when we were starting this problem is we would calculate the interest payment. Principal times rate times time. So we've already done this in a few of the prior videos, so we know that number is 4,000. All right, so if we scroll down just a little bit here, all right, so notice on the first day, this is just to record this first line on January 1, that's the first day. That's when we're going to issue the bonds, and then every 6 months, we're going to pay interest. All right, so that 4,000, that number never changes. All right, so if you notice something I did a little bit differently here, I changed this to June 30th and 12/31. All right, instead of July 1st and January 1. The only reason doing that is because now on 12/31, I don't have to do an accrual entry to accrue the 6 months interest and then turn around the next day on January 1 and pay the interest. I can just do it all on 12/31. It just makes things a little bit cleaner and it speeds things up for you, especially come test time. All right, so let's kind of talk about it. So this is our amortization table. So you can see we have interest payment, interest expense, our amortization. All right, this unamortized premium or discount. All right, so this column right here, column D, is think of it as the T account. All right, that's really what it's capturing. Now, I believe I'm not sure if either the KESO or the Spiceland book incorporates this in, but for me, I just like having it there because I define the carrying values, the face value plus the premium, unamortized premium. So having that number right there next to it makes column E very easy for me. Right, it's up to you. When you look in your book, you'll see how they do it without adding that column in. That's fine. I mean, but A, B, and C are my journal entries. D and E are basically me just keeping running totals of my balances. All right, so remember at the top there, it says the first thing we're going to do is compute bond interest expense by multiplying beginning of the period carrying value times the market rate. All right, so let's do that. So 107, 106 times the market rate is 37.49. And then up here, part 2 and 3 is saying we compute the amortization by taking the difference between those two numbers. So that's 251. All right, so that's going to be my first interest journal entry. All right, so my unamortized premium is now 6855, which makes this 106,855. All right, so now we're going to take the 106,855 times the 3.5%. That gives me 3740, which makes this 260. All right, so that's going to be my next journal entry. My unamortized premium is now 65.95, which makes this 106,595. All right, so typically I've never had an issue where students struggle with amortization tables. You can see it's just basically kind of like a glorified Excel spreadsheet here that we're just filling in the numbers. If you did this in Excel, you could copy these formulas in and do it real quick. So students typically don't understand it, so I just do usually a couple rows on each problem because students get the point. But let's do one more row. So take the 106,595, the beginning of the period carrying value, all right, and that's going to give me 3731, which makes this 269, which makes this now down to 6326, and this is 106,326. All right, so a couple things I want to point out to you just to you make sure you're kind of noticing this. All right, so this column D, notice how it is going down. All right, it's going down to 0 because we're amortizing that premium. And the carrying value, as I said in prior videos, notice how carrying value is going down, but don't think of it that way. The carrying value is always going towards face value. All right, so it started at 107, 106, so it's going to go down to 100,000. All right, a couple other things to think about. So I always try to tell students how, students typically struggle on multiple choice. So here's how I would ask things in multiple choice question. All right, so students, usually get very comfortable with these tables. All right, so use that to your advantage. If I gave you a multiple choice question on a test that said bond interest expense when bonds are issued at a premium are blank, okay? And it'd be like going up, going down, staying the same, less than this, whatever. But remember, notice what's going down here. These numbers are going down, okay? Well, why are they going down? They're going down because I'm multiplying the carrying value times a rate. The rate's not changing. The carrying value right here is changing every time, and it's going down too because it's going towards face value. Okay, and so you could think through, that's a conceptual question, right, with no numbers in it. So, okay, well, when we did that in class, the premium means it starts above the face value. That means it's always going towards it, so it has to go down. That's the number that drives interest expense. Therefore, interest expense has to be going down. Okay, so use things like that to your advantage to help you answer test questions, especially conceptual test questions where students struggle a lot. All right, so let's do our journal entries real quick. 1/1/17. All right, this would be, remember, we're issuing the bonds, so we always get cash for the issue price. All right, that hasn't changed. All right, we would have our premium on bond payable for 7106, and bonds payable always goes on at par value, or face value, I should say. All right, so one thing to note here is if you go back and look at our straight line amortization video, this is the exact same first entry. The numbers are the same. Because remember, the difference between effective interest and straight line is how do we come up with the amortization amount? Well, this first journal entry is just us issuing the bond. So we're not even to that point yet. This next journal entry, okay, on June 30th, then the numbers will start changing. All right, but you'll notice my journal entry itself, the account, so let's not even worry about numbers yet. I'm going to have debit interest expense. I'm amortized the premium, so it has to go down, and I'm paying out the semi-annual interest. All right, so those accounts have not changed from the straight line example. That 4,000 has not changed. The only thing that changes are these two numbers here. This is now 3749, and this is now 251. Okay, let's do the 1231. 17, and you know what? That's actually a typo up here. Sorry about that. This should be 1231.17. All right, sorry about that. 1231.17. So notice we're still going to have 6 more months of interest expense, 6 more months of the amortization on the premium, and we're paying out our cash because December 31st is an actual interest payment date. All right, the numbers here from the table, 3740, 260, and 4000. All right, so the one thing that I mentioned, I changed these dates to June 30th and 12/31. If the payment date was January 1st, they would still do this journal entry with these exact same numbers on December 31st. The only difference is this would be interest payable instead of cash, and then they would turn around and pay it the next day. Okay, so you can see that adds a little bit of almost like busy work to the problem. So I typically will try to speed things up come test time, because I know students are usually under a time crunch on the test. Right. So look, now this process, these journal entries, they would just continue over and over and over and over again to the end of the bonds, just using the new numbers from the table. Okay, so it gets kind of monotonous, but in a way that's a good thing, because that should help you remember it when you're taking your test. All right, so hopefully this kind of helps you understand effective interest a little bit better. I'm going to do the next video is going to be effective interest with a discount. So it's going to look real similar to this. The tables are going to look real similar, and we'll just kind of work things through that. So thanks for tuning in. I hope you check the next one out as well. Thanks.